Have you ever looked at a giant skyscraper and just thought, man, I wish I owned a piece of that? Well, what if I told you that you kind of can? Today, we're diving into something called a REIT. That stands for Real Estate Investment Trust, and it's a way to get property into your investment portfolio without any of the landlord headaches.
I mean, let's just get right down to it. Think about that massive office building downtown, or that super busy shopping mall you go to. What if you could own a tiny little slice of it? And what if you could do it all from an app on your phone? Well, that's pretty much the core idea we're unpacking here. So, what is a REIT, really? Put simply, it's a company whose entire job is to own or finance real estate that makes money. We're talking apartment complexes, sprawling warehouses, even data centers. So when you buy a share of a REIT, you're not buying a single brick, you're buying a piece of a company that owns a whole portfolio of these properties.
Honestly, if you remember just one thing from all of this, let it be this phrase right here. A REIT is basically real estate in stock form. You get the potential perks of property ownership, but with the convenience and flexibility of trading it on the stock market. It's a really powerful concept.
Okay, so that's the what. But now let's get into the how. I mean, how does a tenant's rent check from a building you've never even seen end up as cash in your investment account? Let's follow the money. It's actually pretty simple.
It all works in this simple three-step loop. First, the REIT company goes out and collects all the rent from its tenants. Pretty straightforward. Step 2, and this is the magic part, by law, they have to pay out at least 90% of their taxable income to shareholders. That's you. And they do that through dividends. And then step 3, you can buy or sell your shares anytime the market is open, just like you would with any other stock.
Now, just so you know, they're not all the same. You've got a few different flavors. The most common kind is an equity REIT. Think of them as the landlords. They own the actual physical buildings. Then you have mortgage REITs, or MREITs. They're more like the bank. They don't own the property, they own the loans on the property. And, you guessed it, hybrid REITs are just a mix of both.
Okay, so we get how they work. But what's the big deal? Why would anyone choose to invest this way? Let's flip over to the bright side and look at the real advantages of adding REITs to your portfolio. For a lot of investors, it all comes down to one powerful word: income. Because of that legal rule that forces them to pay out most of their profits, REITs can become absolute dividend powerhouses. They often have much higher dividend yields than your average stock.
But the perks don't stop with the income. You also get diversification, because the property market has its own rhythm and doesn't always move in the same direction as the stock market. Plus, it's so much easier. No late-night calls about a leaky toilet. And then there's liquidity. Think about it. Selling an actual house can take months, right? You can sell a REIT share in seconds.
All right, it can't all be sunshine and dividend checks. You know there's no such thing as a free lunch in the world of investing. To get the full picture, we have to look at the other side of the coin. So let's talk about the trade-offs and the very real risks. Okay, this is probably the biggest risk you need to understand. REITs can be incredibly sensitive to what interest rates are doing. When rates go up, two things happen. First, it costs the REIT more money to borrow and expand its business. And second, their high dividends suddenly have to compete with safer investments like government bonds, which are now paying out more. Both of those things can push REIT prices down. And there are a few other things to keep in your back pocket. Because they're playing out all that cash, there's less money left over to reinvest and grow the company. Also, they're still stocks, so even if a REIT owns amazing properties, it can still get dragged down in a wider market panic. And finally, taxes. Those great dividends are often taxed as ordinary income, which can be a higher tax rate than other investment gains.
You know, this slide really gets to the heart of the whole thing. On the one hand, REITs can feel like the best of both worlds. You get the liquidity of a stock combined with a hard asset like real estate. But on the other hand, it can feel like the worst of both worlds. You get the stock market's wild volatility applied to what's normally a pretty stable asset. It's a fundamental trade-off.
So after all that, knowing the good, the bad, and the dividends, we land on the most important question of all. Do these things actually belong in your portfolio?
Let's break it down. REITs could be a really good fit if you're looking for passive income, easy exposure to real estate, or just better diversification. But you probably want to steer clear if your main goal is super fast growth or if you can't stomach price swings. And notice that last point. For most people, REITs are a great supporting player, but maybe not the star of the show.
And hey, if this all sounds interesting, but you're thinking, gosh, where would I even start? Here's a really simple, beginner-friendly tip.
Instead of trying to pick one winning REIT, you can just buy a REIT index fund or an ETF. That one single investment gives you a tiny piece of hundreds of different properties all at once. It's diversification in a single click.
So we end up right back where we started. REITs offer this really unique mix of income, convenience, and risk. Now that you understand the trade-offs, you get to decide for yourself. Is a piece of that skyscraper exactly what your portfolio has been missing?